Have you ever really thought about how the money in your bank account actually works? Most people assume their money is literally sitting in the bank, like there's a physical stash of cash somewhere with their name on it. But the reality is a bit different. The banking system basically works on the assumption that not everyone will withdraw all their money at the same time. In other words, banks don't need to keep 100% of everyone's money as physical cash in a vault. Instead, they can lend out a large portion of it to other people as loans. This idea isn't new. In the Middle Ages, people used to leave their gold with goldsmiths for safekeeping. In return, the goldsmith would give them a receipt saying something like, "Your gold is here, you can come and collect it any time." Over time, people realized that these receipts could be used just like the gold itself. So instead of carrying physical gold around, it became easier to trade with these notes. But something interesting happened here. Goldsmiths noticed that most people didn't come to withdraw their gold at the same time. So the system slowly changed. Goldsmiths started issuing more receipts than the actual gold they had in storage, and they used these extra claims as loans. In other words, money started circulating that wasn't fully backed by physical gold. Modern banking evolved from this system. Today, when you deposit money into a bank, that money doesn't sit there in full under your name. The bank mostly uses it to issue loans to others. What you see in your account is more like a promise from the bank that you can access that money when you need it. The key point is this. Banks generally don't lend out your deposit directly anymore. Instead, they create loans, and those loans effectively create new money that circulates in the system. So the banking system is really based on a continuous cycle of trust. As long as people trust the system, everything works smoothly. But because of how the system is structured, as the economy grows, credit and money supply also tend to expand. This can sometimes lead to inflation, rising debt levels, and financial instability. For example, in past crises, when too many people tried to withdraw their money at once, a bank run, the system came under pressure and some banks collapsed. This happened because not all money was physically held in reserves. A similar situation happened in 2008. But through a different mechanism, housing loans and complex financial products created huge stress in the system, and governments had to step in. Today, the system is regulated much more tightly. There are local and international rules that limit how much risk banks can take and how much credit they can create. At the core of all this is a simple idea. Money is largely based on trust. This doesn't mean the system is fake, but understanding how money actually works helps you see why it moves the way it does and why it sometimes becomes unstable. In the end, the money in your bank account isn't non-existent, but it's also not just physical cash sitting in a vault like most people imagine. It's more like a claim on a system that